this is actually very, very serious. It's a lot more serious than what led to the decline in Wall Street from the high in September 1929 to the low in 1932 of nearly 90%. This is more serious. It really is. And not only that, but these tariffs, and I mean, the market's initial reaction rather confirms this, these tariffs are basically driving the global economy into recession, slump, depression. I don't know what we'll call it. So we're talking about the enthusiasm, if you like, that you get in the top of a credit bubble. It's that's evaporating. And the consequences on values the whole way across the board can be catastrophic. So big warning to everybody. Well, I think the timing of it is most unfortunate because it's the combination of the things that we saw in 1929 to 1930. And by that, I mean the popping of a credit bubble. This credit bubble is bigger, far bigger than we had in the wake of the Roaring Twenties. And also, at that time, we had the Smoot-Hawley Tariff Act. But the difference really between Smoot-Hawley and now is that in those days, something like 2 or 3% of American GDP, I think, was imported. That's not the case now. Consumers are very, very dependent on imports. And of course, you've also got supply chains. I mean, look at Microsoft, for example. Look at Apple in particular. Apple, they do the design in California, but everything else is outsourced, out to the Far East, China in particular. So this is actually very, very serious. It's a lot more serious than what led to the decline in Wall Street from the high in September 1929 to the low in 1932 of nearly 90%. This is more serious. It really is. And not only that, but these tariffs, and I mean, the market's initial reaction rather confirms this, these tariffs are basically driving the global economy into recession, slump, depression. I don't know what we'll call it. And the consequences of that, of course, are that tax revenues will disappoint. Welfare costs will be higher than anticipated. Government finances will take this very, very badly at a time when government finances are actually in a debt trap. So you then have to ask yourself the question, well, how does this affect interest rates? Because everybody's assuming that interest rates will go down. The Fed will lower interest rates because they have to, and they're going to have to rescue the economy, etc. It's the Keynesian playbook, but it's complete rubbish. In fact, the correct way to look at this is the way the foreigner will look at, say, his investment in US equities. They've got something like 14, 15 trillion, depending on valuations, invested in US equities. That is a hell of a lot of investment. Now, they're not going to hang around while a bear market rages and just sort of sit on their position. No, they're going to sell it down. They're going to panic out. They're bound to. And are they going to go and buy US treasuries and corporate debt? The risk-free alternative. No, as far as they're concerned, that's not the risk-free alternative. The risk-free alternative is to get into cash in their own currency because they're running balance sheets in their own currency. If they're going to see no risk at all or minimal risk, it's got to be back into their own currency. It doesn't matter how bad the currency is. That is where the buying is going to go. And we've seen this reflected already in the dollars trade weighted, which, you look at the chart of that, it's awful. That's the only description I can give it. It fell 2% yesterday. It's like more than 2%. It's steadier today. But, there's no doubt, looking at the chart, that's going to go below 100. It's currently 102. Going to go below 100, and it's going to be on its way to 90. And, we see what happens then. Allegedly, Trump wants to see the dollar lower. He's going to get his wish. But this is very, very bad news because how does the foreigner then get enticed back into the dollar? I mean, the answer is you've got to offer him an interest rate to entice him back into the dollar. You then look at the consequence of interest rates on the debt trap. And oh dear, this gets worse and worse and worse. In other words, we're getting into this sort of maelstrom, if you like, whereby everything is going round and round and round and disappearing into the black hole of nothingness. That is basically what's happening. And it's happening to the value of credit. You cannot reduce the amount of credit outstanding without banks or businesses going bust. That is the way outstanding credit gets reduced. If it's not going to get reduced that way, then it gets reduced in its value. So what will happen is that the Fed will be pushed into interest rate policies which basically destroy the dollar. And we're just in the early stages of this. And as for the commodities, this reaction actually is completely wrong. But it's understandable, being the first, if you like, the initial shock. And bear in mind also that there's still quite a bit of leverage in the US equities. I mean, if you look at the FINRA numbers, I think in February it was it was a short $1 trillion of debt, leverage in the market. That's getting caned, absolutely caned. So you can see that this is not good. It really is not. And first reaction to hit everything, including commodities. I think that the swaps, if you like, in gold and silver and in other commodities, the other futures commodities, are understandably trying to close down their positions. So they bash these prices, they bash them down. And of course, nobody wants to challenge them at the moment. They will manage to close some of their positions at a lower price. I don't think they will in gold. There might be some, but I mean, gold is interesting because on COMEX, there's less than 500,000 contracts outstanding, which is not an overbought situation, if you like. You don't have all these hedge funds long of gold, short of dollar. No, they're not at all. So the amount of stuff that's going to get shaken out on the bull tack, I think, is going to be disappointing as far as the swaps are concerned. Different position, obviously, in silver, because you haven't got central banks buying silver, which effectively is the backstop on gold. And on that basis, this is why silver has fallen by, 6%, 6.95%, I see on my chart today, having had another very big fall yesterday. So that, I think, roughly is where we are, Jesse. It's interesting times. I see this in two phases. I see the initial shock, and then I see people looking at things a little more rationally, and then looking at the opportunities. And to my mind, the opportunities are quite simple. Because it's the dollar going down, buy commodities, buy precious metals. But it's going to take, if you like, things to settle down a little bit before people seriously consider that. Yeah, I mean, the portfolio adjustment at this stage is quite simple, and that is it's sell equities, buy bonds. But bonds are actually the wrong thing to buy. I mean, particularly where you've got duration. Don't buy duration, for goodness sake. So that's what the regulators tell investment managers to do. And anyone who passes a CTA exam knows that, the way risk works in a portfolio is the balance between equities and bonds. Commodities are never mentioned. It's just not part of the whole scene. And indeed, physical commodities are not regulated investments anyway. So, the establishment, and we're really talking about the investment establishment educated by governments and by their regulators and all the rest of it, has a very, very clear and simple response under these circumstances. And what this means is that where you got losses, basically you sell anything else in order to cover those losses. And that's what we're seeing in markets. And of course, the shorts in futures are, making hay out of it. I mean, they really are. That's why we got 7% falls today after 5% falls yesterday. But what we saw at the time of the Great Financial Crisis, I think we see again. At the time of the Great Financial Crisis, we saw gold get knocked from about $1,000. It got up to something like $1,050 or something. It got knocked from there down to about 680, and that was more, sort of more spread out than this current episode. It took, I don't know, 3-4 months for that to happen. But once that was over, gold then went on up to 1920 in late 2011, because you had the knock-on effects, if you like, of the great financial crisis. Particularly, you had, sort of, if you like, European debt problems and all the rest of it. Various crises in Europe, which sort of rolled and rolled and rolled, and of course everybody wanted to get out of credit and get into safety, which was really what happened. This time, I think the situation is actually far, far more dangerous. We might see the authorities trying to steady the equity market. That wouldn't surprise me at all. But look, what we're seeing is the largest credit bubble in history going pop. And it's going pop in exactly the same way as a lesser credit bubble in 1929 went pop, with combination of that and tariffs. Smoot-Hawley Mark II, I'm calling it. I think that rather like in 2000 and late 2008, the initial shock takes out everything, and then people sort of think, hold on a minute, gold is actually where we should be, not in credit, as it were. And I think we're already getting, this is not something else. This time, we got central banks doing it. Central banks are buying gold. Why? They're actually selling credit. They're getting out of paper currencies. They're getting out of fiat currencies. It's a big, big message which we've got to hoist on board. That is the difference between 2008 and today. And of course, they don't buy silver, which is why silver goes down. They don't buy copper, which is why copper's going down. And they don't buy oil, which is why oil and energy is sinking. But that will turn round, because over long periods of time, the purchasing power of gold is very steady when it comes to buying these commodities. So, all this is pretty temporary stuff. I'm not giving a steer in terms of timing. All I will say is that the downside in gold, I think, is extremely limited, simply because central banks are standing there just picking up any loose stock they can possibly pick up. So that's going to keep things tight in gold. We have a real crisis in the markets, and that is going to lead collapsing equity values. And I wouldn't be surprised if this crash continues next week, like big time. That sort of thing begins to affect the banks, because the banks have this stuff as collateral, equities as collateral. And not only that, I mentioned the leverage, around about $1 trillion of leverage. It's less than that now. I should think it's probably around about 850 to 900 billion. But on top of that, you've got the commercial real estate problems and all the rest of it. I wouldn't be surprised if the next thing we see in a few weeks' time is a number of banks, if you like, being questioned about their survivability. The other thing, which is something that hasn't happened yet, is the collapse in crypto. That's going to happen. You've only got to look at how Bitcoin correlates with NASDAQ. It's the same, or particularly the Magnificent Seven. It's the same cohort who are long of Bitcoin, who are long of those Magnificent Seven tech stocks. Watch that Bitcoin. I don't make investment recommendations, but I would not be surprised to see that as one of the best shorts at this stage in the market. So we're talking about the enthusiasm, if you like, that you get in the top of a credit bubble. It's that's evaporating. And the consequences on values the whole way across the board can be catastrophic. So big, big warning to everybody.